Good morning traders. There is one level in USD JPY that just trapped 80% of retail traders overnight. And a second level, 2 pips below it, that could trigger an intervention-style crash. I will show you both, give you 3 exact entries, and explain why the Bank of Japan is now more scared of corporate bankruptcies than a weak yen. Stay until the end for the sniper setup. Most people ignore the session bias is bearish inside a fading range. We are not trending, but we are also not flat. Price is currently 157.15, with daily trend confirmed as short. The 5-hour time frame is pure chop. That means most breakout traders will get slaughtered. The one invalidation level you must write down right now is 157.47. Write this number down. If we break and hold above 157.47 today, the whole bearish structure collapses and we hunt 158.00. But until then, we trade the downside inside a dying rally. Let me narrate the chart from the top down. On the weekly time frame, USD JPY remains below its 200-period moving average, which is acting like a structural ceiling near 158.00. The daily chart tells the real story. The 20-day MA is flattening, the 60-day MA is starting to roll over, and the 200-day MA sits far below near 150.50. That gap is a vacuum waiting to be filled. Price is currently trapped between the daily 20 and 60 consolidation. That is exhaustion. On the 4-hour chart, we have a clean negative divergence. Price made a higher high 3 days ago, but MACD made a lower high. Sellers are accumulating every bounce. And on the 60-minute chart, we are oscillating inside 156.36 support and 157.22 resistance. The 157.22 level is critical because it aligns with the 5H pivot and Friday's rejection wick. Most retail traders are buying the dip to 157.22. That is the trap. Real supply sits 2 pips higher at 157.47, now the fundamental driver that changes the probability. Yesterday's news is not random. Japan panel members urge BOJ to heed firm's funding strains amid Middle East tension. Most traders will ignore this and focus on yield differentials. That is a mistake. What this means is that the Bank of Japan is now facing a dual constraint. On one hand, a weak yen imports inflation. On the other hand, higher domestic rates would crush small and medium firms already dealing with supply chain uncertainty from the Middle East. The panel is explicitly warning the BOJ not to tighten into a funding strain. So the intervention ghost is real, but it is not the intervention you think. They are more likely to verbally intervene or use stealth checking than to hike rates. That keeps USD JPY bid on dips, but only until 157.47 holds. Once we lose 156.36, the event that invalidates this thesis is a surprise BOJ rate hike or a massive US CPI beat that sends Treasury yield surging. Until then, we sell rallies. Here is where most traders lose money. They see a range and try to fade both sides. But the structure is breaking. I am going to give you 3 distinct strategies. Keep watching because this is where money is actually made. Strategy 1, the sniper. Conservative. This is for people who want one high probability trade today. Trigger condition. A 60-minute close below 156.36, confirmed by a MACD crosslower on the same time frame. Do not enter on a wick. Wait for the candle to close below. Stop loss. 157.00 exactly. That is 64 pips of risk. Why 157.00? Because it is the 5H pivot and the level where late breakout sellers would get trapped. Target 1 is 155.80, which is the weekly support. Risk reward 1 to 1.8. Target 2 is 155.20, the 200-day moving average on the 4-hour chart. Risk reward 1 to 2.8. What voids this setup? Any 60-minute candle closing back above 157.22 after the break. That would be a false breakdown. Strategy 2, the active trader. Standard. This is for the pullback mean reversion. Entry condition to 1 risk reward. Target 2 is 156.40, just above the key support. Once target 1 is hit, move stop to break even and let half run to target 2. Let me pause here. Let's see how aligned we are. Type your USD JPY low for tomorrow in the comments right now. I am reading them before I record the next asset. Strategy 3, the aggressor. High risk. Counter trend, but only if you understand how to lose small. Trigger condition. A fake out above 157.22 that fails to break 157.47 within 2 5-minute candles. Enter short at 157.10 on the first 5-minute red candle after the fake high. Stop loss. 157.60, only 50 pips. Invalidation is absolute. If price prints a new 5-minute high above 157.47, the trade is dead. Target 1 is 156.60. Target 2 is 156.18, the hard support. Warning: only for those who know how to lose small and manage risk aggressively. If you hesitate to cut a 30 pip loss, do not take this trade. Never risk more than 1 to 2% per trade. No positions through BOJ verbal intervention or US news. Stops are non-negotiable. If you take the aggressor trade and it reverses, you are out in 5 minutes. Let me summarize the one most critical level for the next session. That level is 156.36. If we close below BOJ inflation math, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of all 8 assets. I will see you in the next one.